newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francince Lacqua here in London. Now, the U.S. president has denied that he's planning to fire Fed Chair Jay Powell, but says he did ask a group of Republican lawmakers whether he should. Now, leaks from the closed-door meeting at the White House suggesting that he had drafted a letter to remove Powell briefly sent markets into a nosedive.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him, but they did. So, no, we're not planning on doing anything. We're very concerned.
Jay Powell, of course, was nominated by Donald Trump in 2017. Now, joining us now is Bloomberg's EMEA News Director Ross Matheson and Emmanuel, Head of European Equity Strategy at Barclays. So thank you both for being with us this morning. Ross, I mean, he appointed him himself. And this is, it's not even a philosophical kind of, concern on, longer term rates. It's just that Donald Trump wants a cut now and Jay Powell is not delivering.
That's right. And he did say, he came out in the end yesterday and said, I'm not planning to fire him, or rather try to fire him, because there's all kinds of legal questions about whether he actually could. But he even put some caveats around that. I'm not currently planning to do this unless ... there's something around fraud. And this is this issue again around these planned renovations to the Fed buildings, which the White House say are a waste of money and far over the top, and questioning all the arrangements around that. And he's going to keep pushing on that. They see that as a bruise to keep pressing on. And whether they want to get traction on that and at some point allege there's been some kind of misbehaviour here over money, of course, that's something that Powell has strongly refuted. But you can see that whatever is the case here, whether Powell goes all the way through to the middle of next year, and then in theory could continue at least as a Fed governor, but the pressure's not going to ease up. I mean, Donald Trump's talking almost daily about Powell and rates and the Fed, and heavily critical of the Fed and where rates are. That's not going to dissipate even if Powell sticks around.
But so, Ross, I mean, the tactic, I guess, is to wear him down so that he resigns. I imagine this is what the Trump administration's, favorite outcome would be. But it also feels like a warning sign for whoever comes next.
Well, that's right. And the reason you saw markets moving so much yesterday is not necessarily because everyone agrees with what the Fed is doing on policy. It's just the question again of is the Fed at some point going to become more responsive, you would say, or even beholden to what the White House is looking at when it comes to monetary policy, and that a replacement, the future Fed chief after Powell, whoever that is, and there's talk about Kevin Hassett and Scott Bessent, very much in the vein of echoing Donald Trump on policy. And do you have an erosion again of the independence of the Fed? And that's really the concern that you're seeing in markets.
Emmanuel, so I saw Jay Powell actually in Sintra at the ECB forum, and I'd never noticed that he had bodyguards before. And actually, there were bodyguards that were very attentive this time. You have a lot of, pressure coming, frankly, from all of the president's men. And the market is just worried about, what is it worried about? Is it central bank independence, or is it actually just testing what the president's power is?
Look, I think there's a game of chicken between Trump and the market to some extent. So markets are resilient, but this resilience is being tested by Trump on tariff. And we had the news over the weekend that we may have 30% tariff on Europe. And then the never-ending, saga on the Fed, right? And I think maybe as long as the markets are so resilient, Trump will try to do what he said he would be doing, right? So he said he would be hiking tariff. He's done that. He said he would have this massive fiscal stimulus. He's done that. And he said he would fire Powell. And obviously now this is what market is worried about, right? Yesterday gave us a taste of what would happen if that were to be the case.
But why is the market so resilient? So what is the market looking at? I know there's, TSMC is doing great results. But actually, do they think that, Trump won't follow through on tariffs and that he won't follow through on firing Powell?
Look, there is this taco, so trade always chicken out, dynamics playing out where, the feeling is that Trump ultimately will do whatever is good for the market. So there is a limit to what he can do, how much disruption he can bring to the market. And then, so far, growth is resilient. Earnings are resilient. And we are just starting the Q2 reporting season, early days. But what we are hearing from JP Morgan, from Goldman Sachs, from most of U.S. investment banks is that U.S. economy is holding up. We have a very good number from TSMC this morning. So despite all this uncertainty, you have corporate resilience, I think, acting as a backstop to the equity markets.
But, Ross, we don't actually know how Donald Trump measures success, right? There's a belief in the markets that he deeply cares about the markets. But it hasn't really, apart from a couple of wobbles in bond markets where he definitely stepped away, we don't really have evidence of that, do we?
Well, he says he doesn't really worry about the markets, but he's always watching them and responding to what the markets are doing. And he's on his own bat talking up the markets all the time, saying this is a terrific time to invest. So he's clearly watching the markets very closely. And, Emmanuel was just saying, the markets are resilient. So Trump takes that as a win. And he's going to keep pushing and testing the resilience of markets on that front, all those things he's done so far. And yet, the predictions of markets cratering haven't come true. He is dialing back a bit on trade again. We've seen even just overnight this idea now of 10 to 15% for a lot of countries. That's actually not far off the 10% baseline we're operating at now. And for a lot of countries, that's not terrific, but it's not terrible either. It's far away from 40, 50, 60% that he's been talking about. So you can see maybe countries saying, hang on, if we just sit tight through all of this, we don't have to negotiate heavily because we'll just end up with 10% either way.
Emmanuel, what happens in your world? Earnings, again, are holding okay. The economy in the U.S., you're right, is holding okay. Is it because everything has been front-loaded in terms of tariffs and the pain will come later, or can the economy just sustain it?
I mean, there is a possibility that, the worst is yet to come, that, the tariff impact will have some impact, some drag on growth and maybe some impact on inflation down the road as well. And there's a lot of anxiety about that. A lot of clients we speak to are not taking for granted the resilience we are seeing in the economy and in the corporate world because they are worried about things to deteriorate in the second half of the year. Look, our own economists are looking for a bit of a soft patch into H2, but without a recession being triggered. We are seeing there's enough strength in the corporate sector, in the consumer sector to avoid a recession. And to some extent, by the end of the year, the fiscal impulse coming from the big, beautiful bill should start to offset this or mitigate some of the drag on tariff. We have, ECB cutting rate. We have Germany stimulating. So net is going to be quite tricky to get to the end of the year without too much damage. But we're seeing the big picture is still a bit of an expansion of this, cycle that we've been going on for the last 5 years.
But Emmanuel, how difficult is it? So we have actually a tariff tracker on Bloomberg, which is one of my favorite things to look at on the Bloomberg website. But it's difficult if you look at earnings, depending on the sector, because the tariffs change so quickly, to have a longer-term view of what some of the earnings or one of the sectors will deliver.
Look, I think the tariff will be a one-off. They will hit when they start, so we'll see a drag on growth and earnings, obviously. But I think at some point there will be other factors playing out. What we are seeing right now within the equity market is extreme polarization. So positioning is still towards the sectors, the stock which are somewhat immune to tariff. So since services, financials, things like telecom, utilities doing extremely well this year in Europe. And on the other hand, sectors exposed to trade, to dollar, to tariff have been doing very, very badly. So within the market, there's already a lot of positioning which has been driven by these tariff expectations. Yeah. What could be a risk is that if you see a broader impact on the economy, they start to challenge this resilience. But I think so far, people have been rightly reducing risk, and that's why there's a bit of cushion going on that helps investors to navigate this uncertainty.
Ross, on the political front, how do we think Europe reacts to tariffs if they're deemed too high? It's also quite exciting to have the Chancellor of Germany here in the UK meeting with Keir Starmer.
Well, that's right. So it's interesting because the EU-US talks are still going on. We haven't had a lot of public commentary in the last few days, but we know that those negotiations are continuing behind the scenes. But they're very tricky because, again, Europe is saying, we thought we were negotiating. Suddenly we got a letter saying, this is your base rate, and that's it. And because this is a particularly tricky one with non-tariff barriers included, a whole lot of other stuff involved, Europe is standing its ground a bit with the US on it. And for companies, obviously, they are heavily saying to Brussels, can we just get some kind of understanding and avoid this escalating? We don't want a protracted trade war occurring. Auto very exposed in this region, pharma very exposed in this region, and a bunch of other sectors as well. But Europe is kind of standing its ground, and that's why this negotiation is dragging on and on.
Given all of this, and given what you said about expecting corporate resilience, but probably some dispersion or diversion, how do you concretely play the markets?
Look, we are still long equities. Summer is always tricky. People are going on holidays. We all need a break, I think, after a very busy first half, hopefully. But I think there is a lot of anxiety about how summer is going to play out. You got the bond market on edge. You got tariff. You got, this is the issue around budget and the Fed independence. So look, we have a bit of barbell allocation, but we are still long risk. The view is, look, we have the direction of travel is still good enough for us to stay with equities, with, again, earnings and growth staying positive. Within the market, we have a bit of a bias towards the domestics, but we've been starting to add back to the dollar exposure, which is very contrarian. But our view is that probably the bulk of the dollar weakness is done for now. And we're going to see at some point some clarity on tariff, hopefully sooner than later. But we think we start to see some emerging opportunities, bottom fishing opportunities in some of these cyclical laggards or exporter laggards. So we are long financials, long telecom, long defense. This is now extremely consensus. We start to bottom fish in some of these cyclical laggards. And we have obviously some bias towards quality as a way to kind of help us to manage this uncertainty.
Emmanuel, thank you so much for all of that insight. Emmanuel Coder, head of European Equity Strategy at Barclays, and Ross Matheson, our EMEA News Director. Now, coming up, finance ministers from the world's biggest economies are meeting in South Africa. We'll report live on what's on the G20 agenda. That's next, and this is Bloomberg. Welcome back, everyone. Now, the world's most powerful finance ministers and central bank governors are gathering in South Africa for the G20 meeting. Attention firmly focused on limiting the fallout of a global trade war. Now, South Africa's central bank governor says tariffs are adding to an uncertain outlook.
In the case of South Africa, the biggest impact had come through the automotive industry and the agricultural sector. The issue about tariffs also raises important issues. We are having to grapple with what would this mean for the outlook of the U.S. economy and the posture that the Fed might take. It is not clear where we would end up. Uncertainty abound.
Now, for more, our chief Africa correspondent, Jennifer Zabazaja, joins us from Ballito in South Africa. Jen, good morning. So what is the sentiment on the ground there about current trade tensions?
Right, Franzén. I mean, if you talk to many of the officials on the ground, they're not going to deny that, of course, there is the focus on these trade tensions, of course, as we continue to inch closer to that deadline, especially if you talk to, we spoke to Governor Kanyaho, as you were just playing there, and he mentioned that there is a lot of uncertainty in terms of their outlook and the forecast as central bank governors, but still there is at least an opportunity and a willingness, that is what he was saying, by a number of these G20 countries to sit down and actually talk about some of the issues that they have and potentially ways in which they could find some consensus. He did caveat that, though, with saying that whether or not they come up with a joint communique that they can agree on by the end of this summit is sort of up for the taking. And so we'll wait to see whether or not that actually plays out. But it's interesting to note here, because this is only the second summit that we've seen happen since the tariffs have been instituted. Of course, we don't have U.S. Treasury Secretary Scott Bessent here. The U.S. is represented by an undersecretary in the Treasury, and so the U.S. still is represented. But South Africa went into this G20 presidency with a number of issues, focusing on issues for the global South. And the question is whether or not they're actually going to be able to get some of these other bigger G20 members to agree on some of the changes and some of the priorities that they have prioritized with this G20 presidency, namely MDB reforms. There's also debt sustainability, climate finance. And so over the next 2 days, we're going to be paying close attention to some of the talking points from the central bank governors and the finance ministers. They're going to be speaking about some of those topics, also talking about things like cross-border payments, navigating AI and how that is working in the workforce. But again, the question is, will we see President Trump, U.S. President Trump, at the Leader Summit later this year, ultimately when the U.S. takes over the G20 presidency. And what does all of this mean for multilateralism more broadly, and how each of these different member countries participate with each other and also deal with these multilateral institutions as well as their own domestic issues at the same time?
Jen, thank you so much. Terrific briefing there. Jennifer Zabazaja, their Chief Africa Correspondent. Now joining us is Robin Niblett. He's Distinguished Fellow and former Chief Executive at Chatham House. Robin, thank you for joining us. I mean, diplomacy is changing. For the worse, for the better, I'm not sure yet. But how do you see, just the trade and tariff, I guess, weight on everyone's shoulder changing allies?
I think that we're in a world in which the US has stepped back from providing a kind of balancing impact on international diplomacy. The whole definition of a hegemon is a country that can afford to not always win. But of course, Donald Trump is about always winning. And once you get into that kind of position, it means the United States is not good at working right now with allies. If you're not working with allies, you're trying to win lots of bilateral battles. Bilateral battle with the EU, with China, with Russia, with Iran. But without allies, my sense is America's not winning in any of them. It's in big fights, but it doesn't have people at its side, which means everyone can try it on. Russia can try to see how far it can push the United States. Iran can see how much it can resist the United States. The EU is trying to resist in the trade negotiations. So I'm afraid we've entered a very unpredictable period where the United States, the change in its whole leadership style on international diplomacy, makes solutions, sustainable solutions, very difficult to maintain. Never mind the fact that multilateral institutions, as we just heard, have no power in this environment.
But are we really witnessing a deglobalization, or is it just that the pool of capital or the rule of allies is moving away from the U.S.?
No, it's a good question. I, like others, reckon we're seeing some deglobalization from a global north-led world economy, which, after all, created some pretty crazy things. The bulk of high-end semiconductors taken from a small island whose status is contested by its big neighbor, Taiwan, China, on a fault line geologically. Who thought that up? The bulk of processed rare earth minerals from one country that's in a geopolitical contest with the world's biggest market. Who thought that up? So we are in a position right now where there is a redesigning of global supply chains, but it is creating opportunities for countries across the global south to trade more with each other. We're seeing some more regional integration in ASEAN. We're seeing China shift its trade patterns from America to ASEAN, even a bit away from the EU. So I think we've got a redrawing of global trade, more emphasis on services, more government interventionism, but it's all not net zero.
How do you see U.S.-China? And I was surprised yesterday to see a reversal from the White House in allowing NVIDIA to sell some of their, really advanced chips to China.
In my sense, yes, the United States has been trying to find a balance. The Biden administration had this famously called a small yard with a high fence, very targeted types of tech restrictions. The Trump administration seemed to be going wilder. They want to win the AI race with China. There's a very strong China hawk instinct across most of the U.S. body politic, except, I think, Donald Trump, who'd like to do a deal. And we're seeing that in what you just described. But ultimately, I think the more interesting thing is China doesn't want to depend on the U.S. anymore. The split is China's been taking its time, trying to do it subtly under the surface. But we're now seeing China, as I said a minute, trying to rebalance its trading position, not rely on U.S. tech, because they know at any point, maybe a successor to Donald Trump could pull that away from them. They are going deep to take on U.S. and tech, complete vertical supply chain for semiconductors and for the AI base they need for their economy. So I think it doesn't need to blow up. It doesn't need to become the big fault line of global geoeconomics. But it's inevitable that China's going to try and pull away from America.
But does it also mean that actually China steps into places where the U.S. is retrenching?
Yes. I mean, the problem with China is that its offer is not supremely attractive. America has the world's biggest consumer market. Most emerging markets want to start selling their exports. The problem is China wants to accrue the commodities of global south countries, turn them into high value-added products, and sell them back, all sold to the rest of the world. That's not a good proposition if you're in the global south. So I think things like, less reliance on the dollar, anti-sanctions, new forms of Belt and Road infrastructure investment, more sort of build operate, get your money back, less debt. I think China's trying to find new ways of filling in the American gap, but its proposal, its offer, isn't as attractive as many would think.
So if you were sitting in Europe, the UK or France and Germany, and it's exciting to see the Chancellor Merz arriving in the UK today, do you have to choose between the US and China? Or can you play a little bit both?
Look, I think, like everyone, Europe also doesn't want to choose right now. The top of Europe's list of hierarchy, top of its list of priorities, is Ukraine. And Europe cannot keep Ukraine sovereign without American help and American engagement, even if we have to buy the weapons. So that is a disciplining force on a Europe that would maybe like to be a bit more pragmatic, triangulate a bit more between the United States and China. So that's why I think at the moment, no, Europe will not choose. And if it's forced to choose, it'll have to lean to America, even if it's to try and look beyond Trump and hope they get a better deal in the future.
When you look at leaders around the world, Robin, is there a friendship or something that still is perplexing? I know there were a lot of questions on what Donald Trump is doing with Vladimir Putin. That seems to have now separated. Could it come back? Like, what's the relationship that you want to know more about?
I've always seen the Trump-Putin relationship as less to do with notions that the Russians have got something on him and he's, trying to make the deal, and more that Trump likes to deal with other people who are strong men. So he'll deal with Xi, he'll deal with Putin, he'll deal with Kim Jong-un. It's much more of a comfortable kind of relationship within the EU, this amorphous, non-sovereign entity, which he just has no affinity for. I'd say more he kind of loathes. So we are seeing more big power relationships. The problem is in America, the leader tends to move on. Whereas in other countries, you've got consistency. So America can't really play that game. You can play it for a brief period of time, as we're seeing with Trump, but it's not sustainable, and they know that.
But Robin, how do you understand what Donald Trump is trying to do? Because I keep on hearing from all corners that no matter what he does is, but he cares about the markets and he wants the peace prize. I mean, he's much more complicated than that.
It's more complicated because it's instinctive, but his instincts contradict. So that's kind of difficult. I'm a man, I'll make a decision by gut instinct. Well, that's fine if your gut instincts tend to lean in one direction. But it's 1 minute I want to win against China, it's another minute I want to do a deal with China. 1 minute is we've got to be all right with Putin because otherwise I've got to be nice to him or I won't get a deal. Next, he's not doing a deal with me. I want to be tough on him. It's very complicated. But I think ultimately Donald Trump wants to seem to be a winner. If he's winning, he'll go with the flow. If he's not seen to be winning, he'll change tack. But the ultimate outcome, obviously, is a stronger America, but it's an America where he looks stronger. That's almost more important than a stronger America. Sorry, but I think it's very, very personalized.
That's so interesting. Robin, thank you so much, as always. Robin Niblett there, distinguished fellow and former chief executive at Chatham House. Now, coming up amidst a slump in private equity exits, EQT has defied the downturn by reporting better than expected results. We speak to the company's new chief executive in an exclusive interview. That's next, and this is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francince Lacqua here in London, and these are your top stories. President Trump says he's not planning to fire Jay Powell after speculation about the Fed chair's future sent jitters through financial markets. President Trump eyes a tariff rate of up to 15% for more than 150 smaller trading partners, while also softening his tone on China. Plus, the world's biggest contract chip maker, TSMC, raises its outlook in a big boost for global AI spending hopes. Now, Swedish private equity group EQT reported better than expected underlying profit in the first half of 2025 as it exits more businesses. Well, joining us now is Franzén, the chief executive of EQT. Mr. Franzén, thank you for joining us. You're a newly appointed chief executive of EQT. You're in a firm that actually delivered some pretty good results. How does it feel to be in charge? Any surprises? And what's your biggest hope for the future?
Great to be on the show. No, it feels great to be stepping into the CEO position. I've been with the firm for quite some time, close to 20 years. I think we're in a really strong position. It's an interesting time for the industry. It's an exciting time for our firm, thanks to our global geographic diversification. I think we continue to execute in a very strong way, also in the current volatile environment. And you see that reflected also in the numbers that we're presenting today, putting 7 billion euros of capital to work in attractive thematic investments across strategies, across geographies, and importantly, also sending 13 billion euros of proceeds back to our investors as we continue to stay disciplined in monetizing deals.
Per, where do you see the biggest opportunities, given all of the uncertainty, all of the tariff talk and question marks about inflation and the like? Is it ripe for new deals? Are you finding them easily, or is there actually a lot of other rivals that also want similar deals?
Well, like you say, it's certainly a volatile and an uncertain environment, but that volatility also creates opportunities, in particular for us, thanks to that global platform that we have. We have hundreds of investment professionals on the ground across Asia, across Europe, we try to leverage that strong local presence with our thematic investment approach to unlock also opportunities in these times of volatility and in certain places also market dislocation, to help us invest in some of the most attractive opportunities that we've been following for years and sometimes decades. And at the same time, we're also staying disciplined in realizing deals, and in certain parts of the world, capital markets are actually pretty strong.
So EQT was recently ranked the second biggest PE firm globally by capital raised over the last 5 years. Do you expect to be the number one slot under your leadership?
I think we're in a really strong position. I mean, the proposition that we have to be one of the scale players in the industry that is really focused on delivering global alpha to private market investors is a differentiated proposition. On top of that, we are one of the few scale players that is not US-centric. And in the current environment, as investors across the world are again focusing on the benefits of portfolio diversification, geographic diversification, I think that is an opportunity for us to continue to scale all of our existing strategies and to continue to take market share.
Per, what about strategic M&A? Is there anything that you'd want to buy right now?
Well, what I would say, taking a step back, right, because of the market volatility and the slightly slower deal-making environment, we have seen a bit more of a challenging fundraising market. And at the same time, there's also a need to really invest into strategic growth opportunities for us as a firm and for the industry, AI, private wealth, the democratization of the asset class. And not all players will be able to make those investments. So we do think that the consolidation of this industry will accelerate, and we want to continue to play an active part in that consolidation.
How much of a headache for you are uninvested funds?
Sorry, I didn't catch that question.
On uninvested funds. So there's some analysis by Bloomberg Intelligence saying that CVC and EQT have the most uninvested funds in the peer group at $57 billion. How much of a headache is that?
I'd say it's an opportunity, right? I mean, having that dry powder in this market environment with the strong platform that we have, I think it's a very, very good time and a real opportunity to also put that capital to work. And we see a very attractive pipeline. In particular, I'd highlight the opportunities that we see right now across Asia in places such as India and Japan. So I think that's a real strength of ours to have that dry powder.
Per, when you talk about opportunities in India or Asia, is there any type of sectors that you see good opportunities? And is it on price or just because they can grow?
we are a sector-focused thematic investor. And we apply that approach really across all the regions as we're investing. In Asia in particular, we're excited about some of the more domestically focused businesses in those target sectors. For instance, in the technology sector, but also within industrial tech and other focus sectors of ours, right? And then leveraging that thematic investment approach with that strong local presence across the region creates those opportunities.
Per, one of the other things that we noticed is in June you announced a big reorganization. Where did you see the company needed change, and what else do you have planned?
I mean, at EQT, we've seen a lot of success. We've seen a lot of growth over the last 5-6 years, and as a result of that, there's also always an opportunity to sort of revisit your setup, your organizational design. At EQT, we have a saying that everything can always be improved everywhere at all times. So it's with that mindset that also during the transition period and during my first 100 days. We've revisited the organization, and there was an opportunity to simplify things, reduce complexity, and as such also reduce the size of the executive committee, the leadership team, from 10 to 8 participants. And with this new setup that we have, I think we're really well positioned to be able to continue to scale and also participate in the ongoing consolidation of the industry.
So is that it in terms of reorganization, or is there even going to be more streamlined for here in the second half of the year?
I mean, we're a performance-oriented business, right? And so, like any professional services business, I mean, there's always an opportunity to run things in a more efficient way, in a better way. On top of that, you have all of the investments that we're making into AI and other productivity enhancing initiatives. We do believe that over time that should allow us to operate in an even better, more efficient way.
Per, I mean, it's pretty incredible. Since the company IPO'd in 2019, you went from 7 billion euros in market cap to 40 billion. And I think it was really this month that you also got included in the OMX 30. Is that, I mean, how important is that for the team and also for your journey?
So the way we think about it at EQT, and the way we've thought about it really since our IPO, is that we just want to continue to invest into our platform, develop the best possible platform in the industry. We know that way we'll be able to continue to attract and retain the best talent in the industry, and that way also produce really attractive results and return for our clients, for our investors, and then the result of that will be shareholder value creation. So we will continue to have that mindset also going forward.
Per, thank you so much for your time today. Per Franzén, they're the chief executive of EQT on the back of results. Now, on to geopolitics in Germany, or politics in general. Germany has rejected the European Commission's €2 trillion budget proposal just hours after it was announced by Brussels. The pushback by the EU's largest member state points to the battle ahead for the Commission as it tries to get buy-in for its next 7-year budget, which begins in 2028. Well, let's bring in Suzanne Lynch, our Brussels bureau chief. Suzanne, thank you for joining us. So how big of a blow is this for the EU?
Well, it certainly is. I mean, this EU budget that was announced yesterday here in Brussels is just the start of this process. So the European Commission suggests this amount, 2 trillion in this event, and then it's up for European member states to look at this over the next year and a half, 2 years, to try and get an agreement. So in one sense, the fact that this huge number, 2 trillion, it was a big increase on the previous long-term budget. The fact that that has got pushed back is not that surprising. The Commission usually goes up quite high because they know that this will be whittled down ultimately. However, I think it is significant that the German government felt strongly enough that they put out this statement late last night. Interestingly, Ursula von der Leyen, the European Commission President, is German herself. She's a German politician and a member of Friedrich Merz's party. So, questions have to be raised here about what was the communication like. Was Germany not expecting this big figure from the European Commission? Should they have known more that this money was coming, that this proposal was coming. One of the issues, of course, is that the EU budget is, for the most part, funded by member states, and Germany, as the biggest European countries, gives the biggest amount of money to the EU budget. So the higher the budget, that is going to impact countries like Germany.
And Susan, meanwhile, the EU Trade Commission has also gone to Washington for talks with his U.S. counterpart. So can we actually expect a deal?
Well, the mood music here is very much that the European Union does want to continue negotiating until that new August 1st deadline. There is no doubt that Donald Trump's threat of new tariffs of 30% last weekend did unrattle people here, did unnerve Brussels and EU negotiators. However, they're saying they still think a deal can be done. But we're also reporting that there is a move now from some EU countries, led by France, that the EU should employ their toughest tool in their trade toolbox, known as the anti-coercion instrument, that they should activate this if there is no deal, if we get to August 1st and there is no kind of agreement, even if it's provisional, with the United States. So I think there's kind of a dual track here. Steady as it goes, the EU is still trying to negotiate, but it's also warning that it can hit back if it comes to that.
Susan, thank you so much. Susan Lynch there, our Brussels bureau chief. Now, the UK and Germany are set to sign a new treaty in London today that includes a commitment to assist each other in case of armed attack. The German Chancellor Friedrich Merz, who's visiting the British capital, has vowed to join forces with the Prime Minister Keir Starmer to confront challenges like Donald Trump's trade onslaught and the war in Ukraine. Now, coming up, Wall Street banks report record revenue hauls as they reap the benefits of volatile tariff-fueled trading. The details next, and this is Bloomberg. Welcome back, everyone. Now, TSMC has raised its outlook after posting another set of stellar earnings. Now, second quarter net income, gross margin, and sales all beat earnings, all beat estimates, while operating profit jumped 62% year on year. Now, let's get more from Bloomberg's MEA tech team leader, Amy Thompson. Amy, thank you so much for joining us. I mean, there's really quite a lot going on, but where's the growth coming from?
Yeah, I mean, this is something like the fourth consecutive quarter of more than 50%. It's all coming from AI. They're a key supplier to the $4 trillion company NVIDIA. Every time NVIDIA gets a new order for GPUs, that goes back to TSMC.
So how does it compare with ASML? Because ASML yesterday was a worry, and it's one of their key suppliers. They reported yesterday. So how do you match up the two?
Yeah, so ASML is one step back in the supply chain. Again, they make these big machines that cost $100 million, and they produce the really high-end chips. But they don't just supply this AI boom like TSMC and NVIDIA. They also supply the Intels of the world and the Samsungs of the world, and they've had a much harder time, a lot more uncertainty around tariffs and how it's going to impact sort of the end markets of consumer electronics. A lot more wariness about actually spending money on one of these big machines. So the CEO yesterday basically said, you know, I can't promise any growth for 2026. I don't know what the impact is going to be.
So how might this week's news around NVIDIA's H20 chips sales to China also affect TSMC?
Yeah, it's really, really interesting. So NVIDIA had come up with the H20 chips specifically to sell into the Chinese market, only to be told you can't sell it into the Chinese market. So it's obviously a huge reversal and great news for NVIDIA that this is open to them again. China is a huge market for AI. But what we might be dealing with, one, they don't have licenses yet. Yeah. So nothing's moving yet. Though I think Jensen Huang said yesterday that he expects it to happen soon. And two, there might be an inventory buildup. So we might not actually see anything being ordered up right away.
So interesting. You're in the space at the moment that everyone wants to know about. Amy, thank you so much, as always, Amy Thompson. And we'll also have an interview with the TSMC CFO, Wendell Huang, which airs tomorrow. Now on to banks. The Bank of America chief executive has stressed the importance of an independent Fed as the long-running rift between President Trump and the central bank chair, Jay Powell, intensified. While speaking to Bloomberg, Brian Moynihan also discussed his company's second quarter earnings beat.
This quarter was the trickiest quarter to get through because year over year, we finally got some NII growth, but year over year, the markets business doing strong, so expense growth was a little more robust. That'll get in line, and then you'll see NII drop to the bottom line, and it will set up for 2026 with even more growth.
When you talk about 2026, one of the things we're going to have is, in all likelihood, a new Fed chair. There's been a lot of talk, even today in Washington, about the Fed chair. And you've said you believe in an independent Fed. But if, in fact, President Trump gets his wish, as is his right under law, to appoint a new chair who will be more in line with his views. He said he thinks the interest rate really should be at 1% or even below that. Is that good for Bank of America? Is that good for the economy?
Well, let me make two things. One is you're absolutely right. In May of next year, the term of the current Fed chair ends after being reappointed, and it's the right of the elected president to appoint the next successor and go through Congress. And I think in that dialogue around that, there'll be a lot of dialogue about, okay, how do you set interest rates? What do you think about interest rates? Because the Fed is an independent agency, and they're meant to be outside the purview of the executive and the Congress. They are called to task, and they're monitored, and they're reviewed, and all the things. But the reality was it's set up to be independent, so that our central bank in America was independent. So I think no matter who gets in, they're going to look at it and have to look at the facts and make a decision. Because if you drop rates too far, inflation may kick up, and then you're going to have to raise them back quickly. On the other hand, if you think the prior Fed has been slow to lower rates, you might lower them faster. Our team believes that the Fed will lower rates in the second half of next year by 100 basis points. No change until then because inflation is still going through the system. That brings the Fed funds rate down closer to 3, which they think is probably more of a long-term rate, and frankly is more similar to what we had for most of American history. What's been unusual is the period after global financial crisis, a very low interest rate structure. That is really not a good place to be, honestly. We'd rather have a higher interest rate structure, a little more inflation, a little more robust economic growth. So I think everybody has to be a little careful about keeping that engine going.
Well, that is the Bank of America chief executive Brian Moynihan speaking to Bloomberg and our David Weston. Now, meanwhile, Goldman Sachs stock traders have posted the largest quarterly revenue haul in Wall Street history, raking in some $4.3 billion on volatility sparked by the Trump administration's trade war. Now, across the top 5 U.S. banks, first half trading revenue surged by $10 billion year over year. Well, joining us now is Tom Metcalf, our EMEA finance and investing editor. Now, Goldman and Morgan Stanley surprised to the upside on both trading activity as well as investment bank. I mean, it's like party like it's 1999. What drove the strength?
Yeah, these banks putting out some really big numbers. It's on the equity side, particularly for a Goldman. I mean, they were up 35%, so record quarter and impressively $600 million above what analysts were expecting on that front. So it's the volatility driving it. It's all the kind of capital market movements and stuff like that. But you look at the fixed income side, pretty much across the board, the banks are putting up big increases. So I'd say almost every bank is probably sitting pretty in the US at the moment.
Yeah, and we heard from the Citi chief executive, Jane Fraser, that volatility is a feature, not a bug of the new world order. I mean, are we going to continue seeing this in earnings to come?
I think so. Great news for if you're a trader on any of those floors. But yeah, effectively, the world has got a lot more complicated, a lot more volatile. And as those decisions reach through, clients are obviously reacting, and that's great news for the bankers.
But, I mean, automatically there are other places of the business where it's more tricky, right? I mean, is it always guns-ho, or is it also because we're expecting deregulation in the U.S.?
Well, as part of that, the flip side of that is the risk, right? It's now a lot more risky, and we just heard, CEO of Bank America, they're going, look, there are sort of warning signs or concerns you might have, even as they say the American consumer is, standing strong at the moment. So it's right now, it does feel like it's a sweet spot, and it'll be interesting to see, how, as things develop, like will one side pull down the other, or, will they be able to kind of float along at the moment despite all the sort of incredible news that keeps on crossing the wire.
Tom, thank you so much. Tom Metcalf, there our EMEA finance and investing team leader. Now, markets in the U.S. whipsawed on reports that the Fed chair Jay Powell was about to be fired. Now, they quickly recovered after Donald Trump denied the reports. Let's bring in our Bloomberg MLive strategist, Ven Ram. Ven, first of all, thank you for joining us, but how did you see yesterday? Because I don't know whether, Donald Trump was testing markets to see how they would react or whether he really meant it. And again, all asset classes behave so differently.
Morning, Francince. Thanks for having me. I think that he was trying to test what the markets would do, and he was also trying to jawbone Powell into quitting on his own accord, because it's not going to be easy for the president to push out Powell by law, because it's not an easy process. But interestingly, we saw the Sell America trade come back, albeit briefly. Bonds being sold off, dollar being sold off, stocks being sold off, but they've got a respite now. But the question is, I think that the markets are kind of still underpricing the risk that Powell could quit on his own accord because of the pressure brought upon him. And if that happens, I think that there is a risk that interest rates could go down immediately, because the next successor is going to be someone who is decidedly dovish according to Trump's preference. So I think that the markets are underpricing that risk. But even so, 1 year from now, it's definite that we will have someone who's going to drive interest rates lower. And what does that mean for America, corporate America? It means that, we are going to have a lower benchmark rate. But, is there a risk that, they are going to lower the benchmark rate even in the face of a hardening inflation? And that will set up the tension in the market where we have a lower benchmark rate but a higher yields actually.
So are there really any real alternatives to the S&P?
Well, I think that, the markets have been frothy for a long time, and I think that investors should kind of look further afield. And there are two viable spots here. One of them is India, because, if you look at the risk-adjusted returns on India over the past quarter of a century, a long enough stretch of period, and if you look at that, the risk-adjusted return is higher and superior in India. And I think that, given the growth prospects that India has, and given how frothy US stocks are, I think that, investors would do well to look elsewhere other than just the US. If they are averse to adding on emerging market risk, they could look at Germany. I mean, here is an economy that is not growing very fast, but at the same time, it offers persuasive value. You're getting the German stock market at nearly 60 cents on the dollar, whereas you have to pay $2.25 to get a dollar's worth of earnings in the US, and that research is out there on the terminal today. So I think that there are compelling pockets of investment corners elsewhere in the world.
Ven, as always, thanks so much. Bloomberg MLive strategist Ven Ram. Up next, Bloomberg Brief, and this is Bloomberg.